Hi, welcome to the second of the workshop series. This is all about virtual accounts. And in this part one, we introduce you to the concept of virtual accounts. So before we understand what a virtual account is, I guess everybody knows what a real account is. A real account are open for current account, savings account for customers. And on these accounts, we can make transactions and do statements. Now, virtual accounts are a set of non-real accounts used to make and receive payments on behalf of a real account. So a virtual account will have in the background and backed by a real account. A customer can have as many virtual accounts as possible. So let's try to understand it with an use case. So let's assume that we have a corporate ABC having one account with its bank. Now, this bank has one real account for the corporate, and it gives the flexibility to the corporate to create as many virtual accounts as possible. Now, the corporate, like any other corporate, has got receivables from its dealers and payables from its suppliers. So for each dealer, the corporate creates a virtual account. So dealer A will have a virtual account, dealer B, its own virtual account, and so on. Similarly, for payables, where it has to give funds to its vendors, for supplier X, I will have a virtual account. Similarly, another virtual account for supplier Y. And if you look at sub-dealer A1, it can have its own virtual account reporting to the virtual account of dealer A. So that means that I can have a hierarchy of virtual accounts. So when the corporate wants to receive funds from, say, dealer B, instead of paying to the actual real account of corporate ABC, it can just pay into the virtual account for dealer B. Similarly, when the corporate is paying to the supplier X, it can pay to the virtual account of supplier X. Let's take another use case of virtual account. In this case, an university which has to receive its fees, the tuition fees from its individual students. Now, instead of exposing the real account of the university to the students for them to pay into, it creates a virtual account for each student. Probably the virtual account could be the student ID or the enrollment number of the student. So the student actually pays into the virtual account, which is easy to remember for them, which could be the student ID. And automatically, when they deposit funds into the virtual account, it gets reflected in the real account. So what all operations can be done on a virtual account? Like any other account, you can do debit credit transactions. You can place a lien, which is an amount block. You can set limits so that it cannot go negative beyond a certain amount. And you can generate account statement. Now, there are two more things which you can do through a virtual account, which you couldn't do to a real account. Number one is to create a hierarchy, as we saw in the case of dealer A and dealer A1. And number two, you can actually allow the corporate to create virtual accounts for themselves. In case of a real account, the corporate has always to come to the bank to create a real account. But in case of a VA, the corporate can create by themselves using digital channels. So what are the key value propositions? We're going to have a look at this in more detail in the next session, but at a broad level, as we have seen, it helps in receivable payable management. Number two, corporate liquidity management is another very good use case. And finally, it segregates the client money. I hope this was a very useful overview of virtual accounts. In the second part, we are going to have a look at the IT architecture for virtual accounts. Thank you.